the other day on CNBC where he was, ringing the bell like people have been doing for decades on our country's poor fiscal household and 35 trillion debt, et cetera, et cetera. And Jim's like, oh, I know that guy. We traded together. I've been to his house. And I'm like, yeah, we got to get Jim on the show. So with that long introduction, we don't have anything set here, Jim. I said we're going to have a good time. We're going to answer questions, both from Greg and me and the audience. But you know what? Let me just warm you up by asking a kind of an interesting question, which I don't even know if I know the answer. What got you motivated and inspired to be a full-time trader?
I was pumping gas when I was 15 years old and up in New Hampshire. And some woman pulled in one time. It's a little farm town. Some woman pulled in with a 280Z. Okay. And I was like, wow, I'd never seen one of those. Right. Couple weeks later, a month later, a couple months later, she pulled in with a 320i BMW. Again, never, you don't see that stuff. Right. And so I started asking her what she was, what she was doing and how she did it. And she explained to me she was a commodity broker down in Boston. And so I started talking to her about it, and she was nice to me. And about a month later, she pulls in, she's got a Porsche. And I'm saying, well, what about your other cars? She goes, well, I still have them. I'm like, oh my God. So long story short, she started giving me the old value line paper charts. Okay. Wow. And my dad was in the construction business. He repaired Ford tractors and sold equipment. And in those days, in the 70s, interest rates were much higher. So if you got a new Ford tractor and you sold it for full retail 30 days later, you still lost money because of the floor plan that you paid to the manufacturer. So my family, we were a Beans and Franks family. We heated the house with wood for years. We had a 10-acre wood lot. And I was reading about the Hunt brothers back then. And again, I'm a kid. I had $600 saved, and the lady was kind enough to, and I think what she did was she liked me. She knew she couldn't really open an account with a minor. Things were different back then, but she opened the account with me. I put my $600 in, and by, I don't know, midway through 77, 78, the $600 was $40,000. And wow. I did what every 17-year-old would do. I bought a brand new Smokey and the Bandit Trans Am, and I bought a fur coat for my girlfriend. And I have my dad want to kick my butt for doing that, right? Because it's cumulatively the most ridiculous thing he ever did. And I got spoiled back then. In a way, it was kind of a curse because I didn't want to do anything but that. Went to college, put my time in there, and then just kind of nickel and dimed it, and over the period of time, I look back and I say, all the lessons I've learned, I probably could have accumulated 17 PhDs for less money and less headache, but here I am, So it's been a trip. Let's put it that way.
All right, awesome. So Greg, what do you think? Should we ask him about his trading in the 90s, or should we ask him to share his approach to the markets, or what do you think?
I think we mix it up. I mean, everybody wants to know what the other guy's doing, his strategies, entries, exits, the mechanics of it. But how do you get to that point of pressing the button is a big part of making the decision to press the button, right? So we can all press a button. That doesn't mean we necessarily have a method for pressing the button. So I think everybody be interested in what's the method. And then from there, how did you get to the point of, hey, that's a trade. Now, how do I manage an exit?
Yeah. What I would tell people, the hardest thing about trading is understanding the separation of your ego and what you think. Trading is more about what's not going on than what is going on. So I've always, a guy along the way have spent time with me, he boiled trading down into, 4 basic concepts: fear, greed, coward, and crazy. So what happens is you're fearful to do the trade, but you're greedy. You'd like to do the trade, but you're not sure. You're not certain of what to do. So that makes you a coward. And then once you get in the trade, you're afraid that to lose your money. So if if the trade goes against you, you become afraid to take the loss. You think it's going to come back. Again, that makes you a coward. Okay. So if it goes up, you don't want to take the trade because you think it's going to go higher. You're going to miss the trade. Again, it makes you a coward. What it basically does at the end of the day, it makes you crazy. And so you get the fear, greed, coward, and crazy that work in conjunction with each other, that cause people to overanalyze, to doubt, to worry. So the hard thing is to really understand that it's your ego that causes you to have difficulties. And in trading, in my opinion, at least, it's more, if I've learned to train my mind to not worry about what is going on, but figure out what's not going on. Because if I go ahead and think I know what is going on and I'm wrong, it can become an ego bruising event. So
Okay.
I'd rather sit and have some type of a system to where I can look at various different indicators, charts, repetitive things, and then when those things line up, okay, I can take a lot of my fear out because I have a system, and if I followed my system, I can have a better than 50-50 shot at being successful. One of my biggest problems in my career has been my entry and my percentage of trades wins is probably extreme. I'm probably a 78 to an 80% winning entry guy or winning picker of my position. But my managing the discipline against my losses is so much more difficult for me because of my ego, the way I've been trained to be right most of the time, that I let my losses get away from me. So no matter how long you do this, I try to practice my same rules over and over again. But no matter how long you do it, it's a never-ending battle that you have with yourself. So to me, it's more about having a system, following the system, believing in the system, and then not being a coward to apply the system. Because if you don't, psychologically, you won't make it long term. You just have to give yourself, almost a conscious lobotomy when it comes to losing money, because it's a percentage of it. And then, of course, behind those beliefs that I've established, I have a system, I have a way to size my account, to size my trade, to size my risk, to understand over a period of time the percentages that I'm going to have right versus the percentage of the time that I'm going to be undisciplined. So I have to probably work 3 times as hard. I've been able to survive because I am right, but I don't keep the majority of my money, because when I'm wrong, I turn it into a disaster. So no matter how long you trade, I'm blessed in that I do not worry about what I think. But when I get into a situation, I'll sometimes get sloppy in even my own self. I'll get sloppy with my own disciplines and create a problem. So nobody's exempt from it, whether you've been trading a week, a month, a year, 2 years, 5 years, 10 years, however long. Everybody kind of fights the same demons.
So yeah, let me ask you this, and I appreciate that background. Just to put a little meat on the bone, so to speak, about your system. I mean, we're both, all of us, we're technical traders. We use something called techno fundamental approach that Greg created. So it's not just technicals in isolation, it's market internals and intermarket analysis. And so I know that you trade primarily just S&P futures, which is a great instrument. But can you add a little bit about your system of the other things that you watch? I know you look at the bonds, the dollar, currencies, gold, the NASDAQ bank sector, you told me. And then Sam just asked, because that's leading into what Sam just asked also, of what do you mean when you say pay attention to what's not happening? So
yeah,
it's related.
well, you remember, Dan, a long time ago when we traded stocks, I was all relative strength, right?
Right.
Like, how does it act relative to itself? How does it act relative to its group? How does it act relative to the market? So like if IBM is a Dow stock and and an S&P stock and a leading tech stock. So what you'd want to do is you'd want to look at the background of what are the other stocks doing, how is the Dow doing, how is the S&P doing, and how's IBM doing. So if all of a sudden, the S&P is down, say 20 handles, and the Dow's down 200 points, and IBM's up 5/8 or a dollar. I'm sorry, I keep going back to
Right.
IBM's up a dollar, right? So is IBM stronger than the market, even with the market, or weaker than the market that it trades, right? So I would say, well, the market's down 200, it's a Dow stock, so it's stronger than the Dow. The
Right.
S&P's down 20, it's a big S&P stock. It's up, it's stronger than the S&P.
Sure.
And then the NASDAQ is whatever. So the one thing that I can absolutely tell you is IBM's not a short, right? So a lot of people say, oh, it's going to come down, it's going to catch up with the market. My philosophy is that thing would be stronger than the market. So relatively speaking, it's stronger than the market. So that stock would be a long, okay,
When you
with
get
a managed stop. So I trade futures now, and I use, basically 5 indicators that I look at,
okay.
which, I'm sure you're all familiar with the VIX, the volatility index. On Thinkorswim, it's /VX. I look at,
Yeah.
whatever the index is.
I'm gonna type them out here. Okay. Go ahead.
Yeah, I look at whatever the index is. Okay, the whether it's the NASDAQ or the dollar or the whatever it is I'm trading. Okay, and then I look at the tick. Okay, I look at the NYSE tick. Okay, let's say for the S&Ps or the tick I look at, and I look at the bank index, the NASDAQ bank index, the BANK, because that's a financial index. And I've found that and things change over time. Like sometimes at one time, the S&P was a leading indicator. The S&P is no longer a leading indicator. It's a lagging indicator. Okay. In my opinion, at least trading futures. And then I look at the US dollar. So what I do is I wait for my setups to decide whether or not I want to go long or go short or long the ES. So for instance, to go long the ES, I would wait for a move up in the VIX. Okay, if the VIX went up, okay, chances are, that's more of a fear based on that particular day. People are buying put protection. So I'd wait for the VIX to move up, or I'm sorry, the VIX to move down. I'm sorry, move up. The index to be doing whatever it's doing, and the tick, I like to buy something when there's a low tick, say a 400 low tick is my general entry point. And I like to see the bank being at or near its high. So I know if I can set those things up, okay, I have a better than 50-50 shot that there might be some interim bottom in the S&P to where I'm safe going long that. But so it's again, it's a fading move. It's a relative strength, relative weakness move within the 4 corners of, say, a couple of indicators that I use to determine strength or weakness to get long or short. And if that's too complicated, I mean, stop me anytime, because
No, it's perfect. It's not at all.
Because like I say, I'm thinking my mind, and
But let me ask you this. When the 3 of us spoke a week or so ago, you said, and what I like about you is you're objective. I've never heard you bullshit me or anybody else. You call a spade, and you're like, guys, the things I look at are out of sync. And that kind of reminds me of something that when you and I were talking before the '08 financial crisis, that you're a deep thinker, you're a deep researcher. You were like, Dan, I at 3 a.m. at night when I can't sleep, you're looking at the whatever you said at the government office, their debts. You're like, look, J.P. Morgan's almost bankrupt here. And you were so confident of that housing debacle, which was the financial meltdown. but you were looking at macro stuff leading up to that. So I know I'm talking two different broad categories here. One is you like putting puzzles together, and when they're not in sync, it's giving you a warning sign. And number two, you were saying that they're not in sync for you currently. And
Yeah, that's right.
third, what is that telling you? I'm throwing three questions or comments at you. And so what is the out of sync tell you or warn you or make you suspect in particular as we're leading into the election? You know, for example, you know, yields have been ripping, and don't answer that question yet, but I do want to ask you about the rise in the yields, the gold, and the Paul Tudor Jones thing. But I've loaded you up with a lot of things already.
Well, you know, and since we talked, because it has frustrated the heck out of me, with especially with the VIX, and what I came to not understand because of the way that we're all programmed is they've always said that the VIX was the fear indicator, right? So fear and people would buy that. Like, let's say you're a big hedge fund manager and you're long a giant basket of stocks, okay? And you want to go ahead and get some protection for that. So you might go in and sell S&Ps, okay? Not because you want to be short, but because you want to protect your position, right? And so when that would happen, since the VIX is a options pricing discovery method, that would go up. Well, what I didn't come into realization, what's been frustrating me, and to lead to the, I guess, more of the macro thing, is that what if in the VIX, why couldn't they price calls the same way they price puts, right? So I started looking at it, and people are buying tons and tons of calls. So you have an elevated VIX, you have an elevated S&P, you have all these elevated indexes, okay? And so more people are betting that the market's going to go up than go down. They're buying upside protection, not downside protection for risk. And when it gets to you know, the second part that I think you asked, the more the macro side, I think with this election, you basically have you're really voting for, if you're a trader or you're a market participant, you're voting, like, say for Kamala Harris, you're voting for wage and price controls, okay, is what you're voting for. With Trump, I believe you're voting for taxes and tariffs, depending on what your view is with that. And at the end of the day, both of them are very, very inflationary, you know, destructive to long-term buying power, you know, ways of thinking. So, you know, when do you guys remember a time when the S&P's at all-time high, gold and silver are at, well, silver's not quite inflation adjusted high, but gold is through all currencies inflation adjusted highs, okay? And the public's not even in it at all yet. The public are not in those markets at all. There's just some random hedging and things of that nature going on. So I'm sitting back and I'm thinking, you know, go to your lesson, Jim. What's not happening? Well, the VIX is going up. Traditionally, that was to protect longs. Well, what if people actually want to be more long? So I started digging and spending more and more time, and that typically after the first rate cut, from wherever the market is at that time, if you go back historically through rate cuts, there's been an 11% rally in the market. Okay, that's the number. And so when you take that from where the Fed started raising rates, okay, 11% puts the S&P at, give or take, 6,300. So, you know, some of these things that you believe to work can be true, but depending on whether you're short biased or you're long biased. I've always traded like a market maker, so I'm always offering things out, which puts me constantly short, where in this particular market, I should be bidding for things to be constantly long until proven wrong. So you can look at the same market. You should look at it the same way, but you have to understand what you are looking at. And, you know, I got confused, and that's what I was calling you about. I'm thinking, well, what the heck? You know, they lowered rates, interest rates are going up. Okay. The dollar is very strong. Gold's up, commodities are up. They used to always tell you that the, you know, strong dollars are bad for the stocks. You know, all the adages that the people on TV, I call it the bear pornographers. They always They're always watching bear porn, right? So they're telling you all these things why it can go down, but what's not happening? It's not going down. So what if that same indicator was that they were buying calls? Could happen, right? But nobody talks about that. So I figured it out. I said, you know what? It's not that the indicators aren't right. It's that I'm looking at it expecting the market to pull back. Well, if the market doesn't want to pull back and I keep fighting it and I go to fear, greed, coward, and crazy, I could liquidate myself by being stubborn. So you just have to constantly be adjusting it. And that's why, like, I like to reach out to people like you, Dan, because you do like to listen to it. And sometimes it's a sounding board. And then if you think about what I said, that's kind of exactly what Tudor Jones said, that we're either candidate, you're voting for inflation. That's what you're doing.
Right.
So at some point it'll be horrible, but where could it be horrible from? I mean, Venezuela stock market went to 100,000. If you were Venezuelan, you'd think, oh, the market's up 100,000. But if you had it priced in dollars, in Venezuelan dollars, you'd be broke, right? So same here. And that's my opinion why these commodities are trading as stoutly as they are, is that people are pricing dollars in hard assets, not necessarily in soft assets. But that doesn't mean that the S&P can't go to 10,000, and that the Dow can't go to 50,000. But at some point, if they do an inflation-based strategy like that, history shows, and a lot of old timers that I know say eventually hard assets like gold and the Dow Jones cross paths. So do they cross paths at gold 20,000, 30,000? People say, oh, that's not possible. But who would have ever thought Bitcoin could be, Bitcoin's up what today? I don't even looking at it, what it's doing.
72,000.
Right, yeah. So all the stuff that people think are crazy might not be crazy. They might be crazy to you based on your mindset, but you have to adjust. You constantly have to move forward. And that's kind of what I try to do. You throw in the towel, you say, you dumbass, you just lost a shit ton of money thinking you're right and smart. Okay. When all you had to do is look what's not happening. So if you think X is happening and Y is happening, that's what's not happening. If you want to fight that, it becomes a self-punishing lesson. There's just no reason for it.
I have a question. So, Jim, these are big picture views as to what's going on, and to come to some conclusion as to placing a trade. So from that point, are you swing trading the futures and holding for days? Or because if they're intraday, and you're talking about VIX and the tick, which leads to, an intraday view. So how do you incorporate such a big view if you're trading them intraday, and what's your holding period?
I try, as I've gotten older, I'm opening up my time frame, because this is another thing that I finally have woken up to, is that, if you come along from, like, say, when I really started electronic day trading, when I did my first firm, there used to be a mechanism called the SOs, the small, it was a scalping mechanism, right?
Right.
And so you had to trade your mind. You couldn't do a SOs order within 2 minutes, right? You had to do an order. So that's where the 2-minute chart came about, largely speaking, okay, or the 5-minute chart. So I still live in that mentality, and what happened is that I've had to adjust my size for my day trading. Like if anybody ever wanted to hack me, any of my stuff, it's either SS 25 lot, SS 50 lot, or SS 100 lot. Okay, sell short 25, sell short 50, or sell short 100, right? So all of a sudden, that might have worked in a call it a an S&P that had a 5 or a 6 or a 10-point range. Now we have 50, 100-point ranges, right? So I can't trade the size that I used to trade intraday. I have to trade such small size to manage the risk that my day trading has become, to a certain degree, what I would often call more of an intraday swing trade. Okay, because I use my retracements, my Fibonacci work, my highs, my lows, my measured moves to do this, to trade the gaps. So I have to trade much less frequently. Okay, much less frequently. Give myself some more room and manage my risk better. So I still consider myself a day trader, I still every day do, like in the morning for the gap fill, I probably do, call it 20 round turns, which would be 40 sides, let's just say, times my whatever contract amount. And then usually between 11:30 and 1:30 or 2, I don't do much.
Right.
And then in the afternoon, I'll get a little bit more busy around 2:30, but it's
Right.
really becomes, I have to shift to more of a relative strength type of thing. So my definition of day trading has probably changed over the years because it's had to for size, but I don't put positions on and just hold them. Anytime I do that, I lose. I get completely smoked, because
Yeah.
I'd let it go too far against me.
So you're a day trader,
Yeah.
and I think you're using the 2-minute chart.
Well, for S&Ps, yeah, I still look at it, which is ridiculous because I wind up with too much stress. So I'm trying to use a 5-minute chart more now.
Sure.
So what I'm doing is I'm taking the same swing trading approach for how to go long, meaning the VIX, the index, the tick, the bank
Right.
index, and the dollar, and I'm just
Right.
tightening up my ranges so that I can scalp and day trade within those, looking for highs of the day, lows of the day, so on and so forth. So yeah, so it makes it more busy. But yeah,
So are
so
you
I
more of a fading the ranges or buying the pullbacks? Like we're pretty, not pretty, we are detailed pattern traders,
okay.
meaning, so we see a type of a pattern that like little shakeouts or failure patterns, and it's like within a trend with support and resistance and putting that all together. Whereas, are you like from that big picture, kind of like an intraday bigger picture and saying, well, I think the market's going to go down, so I'm fading this move up to resistance and something like that, or your relative strength. And in other words, how are you picking your entry point?
Um, well, like I have a I have a little system that I use like in the mornings for gap fills. Do you guys do much with gaps?
Absolutely.
Sure.
Gap work. Okay. So I've got stats that I run 30, 90, and 180 days that show me the percentage of what the percentages of the half gap, the full gap filling. Okay. And so I keep the data like that shows that like over 180 days, let's just take Monday, for instance, or what's today? Wednesday?
Yep.
Over 180 days on over 30-day period, I'm sorry, over 30 days, there's an 86% shot, or I'm sorry, an 83% shot of a half gap full fill and an 86% shot at a full gap fill. But if you take it out 180 days, there's a 59%. Okay. So what that tells me is that the market's trending up, okay, which is what it's been doing. It's over periods of time, over periods of day, the gap fills, the percentages change. So I try to take my highs and lows from the morning gaps, okay, and I try to day trade around those. So I keep on my screen, a 2-minute, a 5-minute, in a 15-minute chart, okay, just to you know expand my highs and my lows so that I don't get trapped or stubborn or try to pick bottoms. Okay. And then that's where it's really important for like paying attention to the tick. Are you selling into a big move? Are you are you buying into in a big move? What's the market doing? So I absolutely use indicators, and I tighten them up on a daily basis, because really in the last, you probably know this better than me, Greg. I mean, really the S&P has been doing a wedging pattern for how long now? 6 weeks.
Yeah.
We had a sell off in August of 180 days, right? I'm
Right.
sorry, we had a pretty good sell off in August, and here we are in November, and the market's never gone back to that, and it's traded in what, 100-point range, maybe 75-point range.
Yeah.
So
Been
so
tight.
so so what I do is I'll look at those highs and I'll look at those lows and say where are we? And it seems like we're wedging in. Like even if you looked at the market now, which is what I consider the daily doldrums. There's nothing going on. It's the market's right at where it opened. Okay. For the most part, or based on the code, depending on what trading system you have, it's sold off to what, 45, 58, 45, 46, something like that. And so you got 30 points of range, but you're still how far off the high? So you're right dead in the center. So I look at that, and if you were to say to me, Jim, pick a trade, pick a direction right now, I would go and I would look at the BANK. The BANK is sold off some. Okay, so I got that going in my favor. The VIX is nowhere. It's 1883. Nothing to do there. The NASDAQ's wedged in. The dollar is, give or take, the DXY, which is a basket of the dollar. It's weak. So what am I going to do? What's not happening? Well, it doesn't look like the market's going down, is what it doesn't look like to me. So if I was going to do anything, I'd put a small position on just to see what's what, maybe on the long side, because that's, the thing filled its full gap fill, half gap fill, and full gap fill, and went through it. It traded extensions, and now its half gap fill is 58.71.75, so it's 6 points off of that. 58.69, the half gap is 50, and then the full gap fills 64. So there's nothing for me to do now. And that's I run that lesson through my head constantly. So I tell people, like, if you want to learn to trade, pretend it's like learning the alphabet. Okay, whoever can say the alphabet the fastest, A to Z, or start and say, okay, let's see how fast you can go from H to R. Whoever can get that down fastest, okay, is probably going to be the one who wins the contest. So I have to constantly take all these indicators, run them through my head like that constantly to figure out what's not going on, and then say, okay, based on my experience, is it worth it for me to put a position on? That's kind of the madness formula, for lack of better words. So whether it's day trading or it's position trading, it works a lot. I don't have a big enough account or smart enough to be like I know what's going to happen long term. I know how the game's going to end. It's just, it can take a lot longer. It can take years to get there, and then it happens in 2 weeks. So we're all walking around looking at each other, wondering how we didn't see that.
Right.
Jim,
do you have an opinion on like the last, I'd say, year and a half, maybe even 2 years? The tick's personality, so to speak, has changed in that we've seen, like years ago, it would be more extreme in its moves, but we've seen these trending moves where the tick is hovering around 0 plus or minus 200,
right?
And the market will keep trending, and even on the spikes, it won't move much until it's like near the end.
Right. I do have an opinion on it, but it would be just that. And I don't know if it's good advice, bad advice. But if you were to take the market and you were to take out the biggest stocks, okay, let's call it the 7 biggest stocks that are the market right now, or seem to be, and you were to look at the rest of them, I think the rest of them are doing horrible. Okay, which might be why the tick is narrow. Nobody's doing anything with them. They're and then so you get these like extreme acts, let's say, when these big 7 stocks are doing something. I mean, that's all.
Yeah, it makes sense.
That's not an educated guess. It's just, well, what is the tick? What is the tick? What is the market? And how's the market doing that we see versus how is the market that we're doing that we trade? Okay. And I think that's why I call Dan every once in a while, because I'm like, well, what the hell's going on here? All the rules that I know, all the lessons that I've learned, I just put those in the trash. Now it's something else, right? But it's always a variation. It always kind of gets back to the same thing, but it gets back to the same thing in a different form. So I mean, that as far as the tick, that I don't know how you feel about that, but that's the only thing that I could think that we don't have.
Yeah, it makes sense. Like whereas years ago, I would say, well, the tick is just hovering back and forth, in that range around 0. And it's like, well, the market's not doing anything. It's you either got to be a hyper scalper, nothing's happening. And now it's like I see that the market's just going to keep trending up or down.
Exactly. Yeah. And
That's what's
exactly.
happening now. Things changed.
Yep, things changed, and because I really think on the broader view that, and I never thought I would say this or start practicing it, but on my subsetted screen, I've got the U.S. dollar, the British pound, I got the euro dollar, the U.S. dollar, and I got the U.S. dollar, Japanese yen, and I'm looking at interest rates. All of a sudden, I'm having to think differently than just these stocks are hot or this section's hot. That's whatever. There's stuff that's going on underneath the market that it's beyond my pay grade. Sitting over on Acorn Avenue in Tampa, Florida, with my Verizon login, right? So I just look at the stuff and try to remember, what I know, what I think, and whether or not I'm successful. And as far as that tick goes, the only thing I can think is, and you'll probably agree with that, is if you look at really what the market is, and if you broke it up and said, we're looking at the market at all times highs, but is the market really at all time highs if you broke out all the different sectors? Like, I don't know if you've looked at one of the most, I think, telling things of all. If you guys have Thinkorswim, and you go on the gold chart, okay? Put a minus sign, go minus side flash GC. Have you ever done that?
No.
I don't use that platform. Dan does.
Okay, look at that chart, Dan.
Minus /
Minus / GC.
Okay.
You see that? You see it?
I got to pull it up here on this laptop. Minus / GC.
Yeah.
Yeah, it's in a core downtrend.
Yeah, you know what that is? That's the dollar priced in gold.
Wow.
So when you figure out what's not happening, there's what's not happening. So then start taking and working it backwards into currencies, and maybe we can understand a little bit more about volatility pricing and maybe even tick pricing. Yes, look up some of that stuff. Look up some of these inversions of indexes that we look at.
But wait, why I'm having this has to sink in. GLD is at all-time highs, dollars at multi-month highs. So why is this in a core downtrend?
Because that's gold priced in dollars. That's your dollars, your dollar value.
Okay. So since dollar's high, it's cutting the value of a hard currency, a hard commodity.
Yeah. With the higher gold's going,
right.
That chart's showing what they're doing to your buying power.
Got it. So let me continue on this thought. We're all in agreement. Hey, we trade the charts, don't fight the tape. What's not happening, I appreciate all that. But I think you kind of implied that, hey, the shit's going to hit the fan one of these days, 5 years, whatever the case.
Well, I don't know that, but it's just it long term. Yeah, you saw that chart I just showed you.
Okay, all right. Well, let me rephrase the question then. Is there any combination of things that you are watching, monitoring closely to give you the higher confidence that there could be a big trade on the horizon for you to profit from? Similar to the housing crisis in 2008.
Yeah, no, and that's why I'm confused, because it looks to me like, the market, the S&P has that hockey stick thing going. It's nice and flat at the highs, and it looks like it just wants to go up.
Right.
So I look at it from a seasonality perspective. The only, I think everybody's waiting for something to happen with this election and the market to dip so they can buy the market. So I'm not going to try to like short or stay short anything. And I'm not going to try to be long or stay. I'm probably more hyper on my toes now than I've been in a long time, because everything that I think is happening or should happen does not seem to be doing that. And I think that that's because I believe that the Federal Reserve knows that a large part of everybody's confidence is that their 401ks at all-time high, this, that, the other. Everybody talks bubbles, but I think that any monster dip that we get, if we get a monster dip, I think they're just going to print money like crazy and it's going to rally. So, I mean, I've kind of given up I used to always think that the market would go down and people would learn their lessons and we'd get back to values and there'd be PE ratios and all that. And it just, that's like a nice fantasy, but I'm 63. I've been doing it for 17 years. I've caught it since I was 17. I've caught it plenty of times. I've been right on some big things a couple times, but I've also been wrong big time on a couple things. So here you go. It's back to 50-50 in managing being disciplined. That's really it, so that's why I think like what you guys do is important. If you can stay focused, if you guys have the energy to collaborate and put together a plan on a daily basis, if that's what your goal is, and stick with that plan, I think that's the safest thing to do. And anybody that's out there listening has to just really be disciplined, and they have to really not be emotionally attached to say their money. You remember I used to say to people, Dan, people, I used to say, well, you need to trade 100 shares. Well, you can't make any money trading 100 shares. And I used to say, well, in absence of knowledge, expect losses. And then in absence of knowledge with big size, expect big losses. So if you guys have a system that you do to keep people on track, okay, within that, and you have a way to, grab them by the neck and tell them to, don't be mad that you lost on that trade. Follow the stop, follow the discipline. That if the market goes down, the S&Ps go down 1,000, 2,000, you guys will make money off that if you have a system. And if it goes up, you'll have a system too. I think it's the opinions that might be dangerous to us with all, which is always the concept of what's not happening. So, as much as I get mad, I drive around in traffic. I think everybody knows about the S&P and the bond and the VIX and stuff. And I'm stuck in traffic with some idiot with a brand new $200,000 car that's just, looking at his next piece of real estate. I want to bite my knuckles off. But again, that's my opinion.
Jim, Donna's asking here, does this negative / apply to other commodities?
There's quite a few that you can put in there. You can try you can pick them out what you're looking at, put / but then it's what's it priced in. And if you look at, basically what that's doing is showing you the purchasing power of your dollar priced in gold is what that does.
Right. No, Greg, I'll send you a picture of it. Wow.
It's pretty interesting, don't you think?
Yeah. So let me
I think it's just dividing one into the other. You could do it that way.
Maybe.
Yeah.
So Jim, I like the macro stuff too, and I'm not an alarmist. I'm just curious that with this more people talking about our record, just stupid, reckless Congress spending, 2 trillion deficits, 2 trillion deficits a year to add to our 35. And some people are saying that's why that the yields have been rising like this. So, yields can rise for a couple of reasons, like people buying bonds, of course, out of safety, yields rising because they don't trust the recklessness, or an inflation. Rising yield is a sign of rising inflation. So my question is, will any one of us be able to recognize when the Minsky moment comes? Like, what will that look like? They say that on TV. Well, it's going to go on for decades until it doesn't. Okay. My question is, what will it look like to say, here's exhibit A?
It'll turn up into currencies. I don't think the yen dollar trade's unwound, okay, at all. The carry trade.
Right.
And the dollar getting stronger doesn't help that trade, right? Interest rates going up doesn't help the overall positioning. And, unfortunately, fortunately, however you think about it, it'll be like when long-term capital management happened. Who would have ever thought that the Thai baht and the Russian ruble could get upside down until you blow up some banker in Chile that defaults on this guy, and you know what I'm saying? And then it's there, so,
Right.
unless you're really, dug into the weeds, to give you an idea how wrong I've been on that concept is, remember I used to keep my hair like you or Greg, remember? I used to be short haired, clean cut guy. Check this out. Halfway down my back. You know what that's for? You can go on CNBC. There's a clip when Santelli used to work in the pits and have his thing down there. When they were first doing quantitative easing, we made a bet down there. We had a little charity going down there. It was called Mullets for Gullets. Okay. It was raised money for a couple guys that had Crohn's disease, right? Some crazy bets we used to make. And so the bet was that interest rates would go back to 5%. Because if you remember when they did QE in 08, 09, they took them down from like 5.5%, just right straight on down, right?
Zero.
So midway through that process, we all had a bet and a talk like we're talking about now. And the guys who thought interest rates were going to go to zero had to grow beards.
Or negative even, they were talking.
Yeah. They had to grow beards. And the guys who thought the interest rates were going to go up had to grow ponytails. And then at the end, we threw a bunch of money in the pot. And whoever lost the bet was on the counter side of the bet. The other guy got to shave the beard or cut the ponytail, take it across the street to the calzone guy, make a calzone. You had to eat the calzone. That was it. We used to do bets like that. And so here it is since 08 or 09, the interest rates mine was 5%. So the interest rates went above 5% this last cycle, but didn't hold. Okay. So I said, I'm dying to cut this thing off. But in order to do that, I need interest rates to close above 5%. That was what, and nobody's around anymore to make the bet, but it's something still in my head. So I think if interest rates trade to get to that bigger picture, I think if interest rates trade back up to 4.75%, it's going to trade 5 again, like 4.83. And if I think that does happen, I think that carry trade is going to unwind, and we're going to have a flood of dollars back into this country like you can't believe. And that's really what's going to cause the inflation to kick off. And because that's really what it is. When you keep devaluing it, let's say you're in Japan, I send you a Toyota, you send me a Toyota, I send you an IOU, right? And back in the day, it cost, 500 of your yen to buy one of my dollars. So you lend me the money. And then all of a sudden, by the time the turn's up, it's 100 of your yen to one of my dollars. You just lost. You sent me a Toyota for free. And I think that's what we're seeing. That's why I'm looking at a lot of currency pairs now, because I think that it's going to show up in the larger markets, some of the bigger, more, currency-based markets. I think it probably would have already happened had we not had this AI. If you guys remember, the market was rolling over, was acting pretty sick when they came out and, Jensen Huang said, oh, AI is the future, right? I mean, the market's been straight up since this AI trade happened. So, whatever the reason doesn't matter. It's the fact that it did. But I think with interest rates going up like they are, with the Fed saying they're going to lower rates, I think that's already a rejection. There might already be gold as high as it is and interest rates rising. There might already be a fear trade that's going on that we're not aware of, from a macro perspective. That's how I feel, at least. There might be a fear trade here. And what's the catalyst to create selling? I don't know. But what's not happening is the Fed lowered rates. What would you think bonds would do? Would you think they'd go up?
No, go down.
But I got that wrong one time too. And when Greenspan and Robert Rubin, when Clinton was president, Greenspan, everybody thought things were going to collapse then. Goldman Sachs lent a shit ton of money to Mexico with the Tesabonos. Robert Rubin was a Goldman Sachs partner. He went and became the treasurer. And what they did was they did a strong dollar policy to try to attract investment capital into the U.S. They wanted it to come into the U.S. So everybody thought that was going to be inflationary. It wasn't. You had the S&P go up. Yeah, you had interest rates go up. You had the S&P go up, and then that set the stage for the NASDAQ collapsing in 2000. But how long does it take to get there? Nobody knows that answer.
Right.
But they keep doing the same things. They go to the same playbook over and over again. And Powell's going to sacrifice. I mean, let's face it, the guy's a private equity guy, right? So, you know, I really thought that he was, because if you remember when he first came into office, he started raising rates. Remember, how many years ago was that when the market collapsed around Christmas time? Everybody was expecting the Santa Claus rally, and the S&P sold off hard. You remember that? So, and then what happened? They sat him down and he started lowering rates, took him to zero, you know, so who knows? That's why I think like that /GC and some of these precious metals pricing and interest rate complexes are interesting. Wow. And, you know, and we're talking macro, which is probably, you know, it's entertaining and it's easy to sound smart talking about that. But to try to sit and figure it out for like your listeners or your you know, your guys' personal, you know, training and trying to keep people alive, you should be aware of that stuff. But if you have a good system and you're disciplined within your system, I don't think any of that matters one way or the other. Right. I say just be knowledgeable of it for your own personal beliefs. Like if you have debt and can get out of debt, get out of debt. You know, just try to have no debt. That's always been my thing. You know, I mean, I've always been so scared of it. I've never had a mortgage, car payment ever in my life. I look at it like my wife used to always get mad because I used to look at buying the house like making a margin call. I'm thinking, oh my God, let me put my stop in instead of paying the 200,000. Why do we got to buy the 500 when we can have air conditioning in the 200? I always looked at it as a bad trade. Shows how smart I am. Real estate went through the roof, you know, should have bought more of it.
Hey, Jim, let me ask you a question. A couple of people are asking here before we sign off. If Greg pulls up the ES, I know Greg obviously doesn't have your whole setup, but could you walk us through for the listeners, you know, maybe a trade or two you did recently?
Sure.
Yesterday, whatever.
Yeah.
And since he can't simultaneously show everything, you can just verbally say, you know, here's where I did it. The VIX was doing this, the banking sector was rallying.
Yeah.
Put the pieces together for them.
Sure.
Just tell them what time frame you want to look at.
Okay. So like on the ES, I 58.39. Okay. 58.39, which was Tuesday.
Yesterday
was the base of a old top of a gap. It's funny because the market's now trading off the gaps because it's trending higher. So I put some longs on, give or take around that 58, 39, 40, 45, something like that. Okay. That was a good move that I did on yesterday.
So at the bottom of that tail on the upper left that Greg's showing?
Yeah, I can't, well, wherever Tuesday where it got down to what it traded like 58.39, 58.40, is that right? Am I looking at it?
Yep.
Yeah, I got long there, and the reason why I got long there is there's 3 gaps that were about that number that it would not trade through those gaps and fill the full gap fill. So I said, okay, it won't fill the half gap. It won't fill the full gap. It's trading down to the gap. So I went ahead and I bought it there with a stop being if it completed the full gap fill. So I did that trade. And then
when you say gap, you mean SPX or SPY?
Well, I trade the future, the forward / the ES. I'm trading the actual future, but it should be the front month future, so it should correlate similarly, I would think. But
right, but he's saying that the ES doesn't gap. So or you're talking about the SPY gap?
Well, I mean, there were gaps, gaps in the market, highs and lows
Right.
that it traded when you do the gap math, and that the ES, I mean, the ES is a reflection of the SP. They're the same pretty
Right,
much.
right.
They just move different. So yeah, so there were some gaps, full gaps and half gaps that didn't fill. So when it sold off to there and it wouldn't trade through those gaps and make the full gap fill, I went ahead and started buying some longs. And if you look at like a longer term chart, if you go back to Thursday, Thursday, or you go back to the following Wednesday, you can see there's almost like the market traded the same spot. Thursday it did it, Friday it did it. It gapped down to it on Sunday. It gapped up, it wouldn't trade it to it on Monday, and it did it again on Tuesday. So I said, okay, either 3 times the charm and it's going to go down, or I'm going to try to buy that dip. So I bought that dip. It did it. Today it got down to the S&P got down to 58.45, which was give or take where I got long on, say, Tuesday, 39.44.45, and it spiked up. So and right now it's in the middle of the range. So that's what I was doing against for futures against my gaps. And with the future, like with the VIX, if you look at spikes in the VIX, like the VIX spiked to, call it 1932 or 1930. Well, that was the corresponding low. So
Right.
in between that range, if you look at the VIX chart and the ES chart, like right now, the VIX is ticking up a little. The S&P is coming in. So to me, I'm bearish the S&P or the SPY at 1920 and above. So if the VIX trades 1920 and above, I'd be bearish the S&P, which goes to my signals for how do I wait to go long or to go short, which is what's the VIX doing, what's the index doing, what's the tick doing, and then I try to enter into those trades on a low tick. So if it goes down and it spikes off like that, and all of a sudden the tick becomes a low tick, I'll go ahead and give it a shot for a long, because I feel there's probably some exhaustion there. Why not give it a shot? And it worked, but those aren't trades that I'm doing with any size or any, I'm trading like that. Call it half size is what I'm doing.
So
But
Jim, it sounds like you pick your level and then enter. Is there any kind of a confirmation pattern, or it's just like that's the area?
well, yeah, I look at, like I say, I look at the gaps. Okay, I look at the filled and unfilled gaps, and then as it approaches those, call it, people could call that support, resistance, whatever, different
Yeah.
terminology for it. When it gets there, if the VIX is doing what I want it to do, like for instance, if the market's down and the Nasdaq Bank Index, the BANK, is up, I don't trust the S&P as a short. Okay, so I have to get 4 pretty good solid confirmations, and then I have to rank those things based on kind of what have you done for me lately, and I put my stops in. So I say, I'm not there's no sure thing, but if I can get 2 out of 4 things right, I might try a half size trade. If I can get 3 out of 4 things right, I might try a full size trade with a stop. And I found that when you can do that, you kind of you give yourself a little bit of an edge, a percentage edge. So, it's my trading's fluid because I'm looking at the same things day in and day out, probably the same as yours is. And that's just like we talked earlier in this talk about the S&P is wedging in, and it's making lower lows and higher highs within that wedge, but it's wedging in. And if you look back, you could draw highs to lows, and you could see that there's nothing above, but there's a bunch of, call it unfilled gaps, or call it support at, say, those numbers that I've tried bouncing off of. The other thing I use, I don't know what you guys use for moving averages, but I use I try to look at the only moving average I ever use anymore is 150-day moving average. That's it. I pay more attention to the gaps
Right.
and
Sure.
the highs, the lows divided by the math, whatever your gap fill math is.
Right.
If that answers your question.
Got it.
All right. Yeah, Jim, no, this has been awesome. Yeah, we like to keep it.
Yeah, and if I'm too random, like I said, I
No,
get,
no,
I
not at
think
all.
everybody knows things or whatever, and they don't. If you guys want to like ever hone in and ask me for some like help on what it is that you or your viewers are interested in, I'm not saying I'll be right, but we can compare notes.
Sure. Yeah. Always interesting. Good conversation. Thank you.
Yeah, it was fun.
Thanks,
Yeah.
Jim. Appreciate it.
Talk to you guys. Bye.
Bye bye.